Good morning, ladies and gentlemen. It is really my great pleasure and honor to be here again after some time and to present the actual CNB's view on recent and especially on the expected future economic developments. Let me start by introducing the structure of my presentation. First, I will stress the assumptions on which the new forecast is based. After that, I will present the new macroeconomic forecast, the headlines of it, and I will go through all the necessary details surrounding the overall macroeconomic picture. And finally, I will provide you with a brief comparison between the new forecast and the previous one. As for the assumptions of the new forecast, let me start by the external side. As you know, the GDP in the euro area has successfully bottomed out from the trough of the economic cycle, and the GDP in the euro area started to grow. The new forecast is based on the June consensus forecast and the respective market outlooks. The consensus forecast expects that the GDP growth in the effective euro area will further accelerate this year and in 2015. Let's say, unfortunately, because of the previous long-lasting and quite severe economic downturn, producer prices developments is very subdued in the euro area, and we can expect that these prices will decline throughout this year, and only modest recovery can be expected for the next 2 years. The subdued producer price development will be affected not only by the previous long-lasting economic downturn, but also by low world commodity prices and previous appreciation of the euro against the US dollar. So reflecting that, the outlook for nominal interest rates in the euro area is quite low, even lower than in the previous forecast, which reflects especially the latest action taken by the European Central Bank to further loosen its monetary policy. The euro against the dollar will slowly appreciate from its current levels, but the outlook is shifted a bit higher compared to what we expected when we were preparing the previous forecast. And the crude oil prices will slowly decline from their current levels. As for the domestic assumptions, as you know, the public budget deficit following the quite restrictive fiscal policy turned to be well below 3% last year, which was reflected by the fact that the excessive deficit procedure against the Czech Republic has been recently abrogated by the ECOFIN Council. As for the outlook for public finance, we can expect that public revenues will be positively affected by buoyant economic growth over the whole forecast horizon. Simultaneously, this new forecast no longer includes the tax reform approved already back in 2011, which should have taken effect as from 2015. So there is a change compared to the previous forecast. The headline for public finance outlook is that we can expect quite strong boom in public investment, which will be fueled not only by domestic sources, but especially by the EU co-financed projects. All in all, we can expect that the fiscal policy will generate mildly positive expansionary fiscal impulse in 2014, followed by a more pronounced positive fiscal impulse in 2015. After the previous programming period concerning EU funds will fade away, its effect will fade away from the public investment growth, we can expect a sharp decrease in public investment in 2016, which will generate slight restrictive fiscal impulse in that year. As for the assumptions concerning domestic monetary policy, let me mention the following. The new forecast assumes that the exchange rate will be used as a monetary policy instrument until the third quarter of next year. As you know, the exchange rate of the nominal exchange rate of the krona against the euro has been extremely stable in recent months and has been hovering around 27.4 crowns per euro. Given this very low volatility, the forecast expects that the exchange rate will remain close to this level over the next couple of quarters, which is slightly weaker compared to the level of the actual exchange rate commitment. The forecast simultaneously expects that the market interest rates will be flat at their current very low levels until the third quarter of 2015. The new forecast simultaneously assumes that the return back to the standard monetary policy regime after the exit from FX interventions will not imply appreciation of the exchange rate to the levels recorded before the CNB started intervening, due to the fact that the weaker krona exchange rate is in the meantime passing through into the domestic nominal variables, including domestic price level. Let me now proceed to the headlines of the new macroeconomic forecast. Headline inflation, which is currently very low, will go up starting the third quarter of this year, and at the monetary policy horizon, which is the second half of last year, it will be reaching the 2% inflation target of the CNB, where it will be also in 2016. Monetary policy relevant inflation, which is headline inflation excluding indirect tax changes, will be slightly lower than the headline inflation because of some expected indirect tax changes, and will thus be just below the inflation target at the monetary policy horizon. As for the story behind this inflation outlook, we can expect that the currently non-existent domestic pro-inflationary pressures will start building up over the next couple of quarters, due mainly to rapid nominal wage growth, especially in business sector. In contrast, current inflationary effect of import prices will slowly evaporate throughout the rest of this year due to subdued outlook for foreign prices and because of the stable nominal exchange rate. Following the decline of GDP we observed last year, the economic activity will start growing this year by almost 3%, and the same growth pace will be probably seen also in 2015 and 2016. This quite buoyant economic growth will be driven by accelerated external demand and easy domestic monetary conditions via both weaker exchange rate and via low nominal interest rates. And as I already mentioned, the government investment will also fuel domestic economic growth. The swift economic growth will be positively reflected in the developments on the labor market. We can expect that the nominal wage growth will first renew and after that accelerate, and that the rate of unemployment will gradually decline. As you can see in this graph, inflation, which is currently very low, will start accelerate in the second half of this year, and it will gradually approach the inflation target of 2% in the second half of next year. The currently very low inflation has been caused by decline in administered prices, which were accompanied by unexpectedly rapid fading away of previous food price increases. On the other hand, looking at core inflation, we've seen that this has, for the first time in the last 5 years, turned positive, reflecting an increase in prices of both tradables and non-tradables items. Tradable items growth turned positive for the first time in almost 13 years. The main driving factor standing behind these developments in core inflation was the depreciation of the nominal exchange rate, which passed through into the domestic price level, is developing broadly in line with what we expected. And the other factor is the quite rapid fading out of previous domestic anti-inflationary pressures, which are evaporating maybe more quickly than we expected before. Looking in this graph, we can see that the monetary policy relevant inflation will follow roughly the same pattern as the headline inflation, and will be only slightly below it because of some minor effects of indirect tax changes we expect on the forecast horizon. And the monetary policy inflation will also get close to the target at the end of next year. As for the indirect taxation changes, we can expect an effect of approximately 0.3 percentage points given by the increase in excise duties on cigarettes, which will be partly compensated by the introduction of the second reduced VAT rate of 10%, which will have opposite effect of approximately 0.07 of percentage point in 2015. Net inflation, which is currently still quite low, will be picking up until the end of next year, and the reasons will be recent import price increases and accelerated economic growth and the improved situation on the labor market. Administered prices, which growth is currently quite negative, this decrease will moderate throughout the rest of this year, and in 2015 administered prices will decrease by only 0.3% due to low energy prices and due to the abolition of most of co-payments in healthcare services. Core inflation, which, as I already mentioned, turned positive in recent months, will continue to increase further until the end of 2015, and it will happen in the environment of pronounced economic recovery and renewed and further accelerating nominal wage growth in business sector. Food prices will increase only modestly this year. As you know, their current year-on-year figure is close to zero, and some visible growth in these items can be seen only in 2015, following the import price increases of food and lagged effects of higher agriculture products. If we look into the structure of domestic inflationary pressures, looking at the upper graph, we can see that domestic inflationary pressures, which are currently non-existent, will quite rapidly building up in the coming quarters, reflecting the buoyant economic growth driven by both domestic and foreign demand. And the yellow bars will be significantly increasing. On the other hand, current inflationary effects of import prices, given previous depreciation of the nominal exchange rate, will smoothly be fading away throughout the rest of this year as a result of already mentioned subdued growth in PPI in the euro area and following the stable nominal exchange rate of the koruna against the euro. The growth of nominal marginal costs in domestic intermediate sector, which is currently very low, will accelerate in the coming quarters, which will be given by increasing wages and cost of capital, whose effects will be partly offset by curbing productivity by curbing effects of productivity gains. GDP growth has taken momentum in the last quarters, and we can expect that the pace will be approximately 3% for this year and for the rest for the following 2 years as well. This swift economic growth will be a result of rapidly growing foreign demand and relaxed domestic monetary conditions, fueled as well by booming government investment, as I already mentioned. As you can see, the year-on-year volatility, of year-on-year figures is given by the effect of front-loading of cigarettes, similarly as we saw in previous forecasts. As for the structure of the economic activity, we can expect that household consumption will be growing at a robust pace of approximately 2% on the whole forecast horizon, and it will benefit from the positive developments on the labor market by quite rapidly growing real disposable income. Investment recovery, which is also expected in our forecast, will be influenced by strong public investment, financed from both domestic and EU sources, and its volatility is given by the front-loading of cigarettes. It will happen. It will touch the inventories profile. We can expect robust but slightly decelerating dynamics of both export and imports in 2015 and 2016. As you can see in this graph, growth rate of exports has recently quite significantly outperformed that of foreign demand, which is the result of depreciated real exchange rate of koruna, which meant an improvement in price competitiveness of domestic producers on foreign markets. This positive real exchange rate effect on exports will gradually evaporate throughout the rest of forecast horizon. Imports, on the other hand, will broadly follow the dynamics of exports, being also fueled by growing domestic demand. And one can bear in mind also that the improved price competitiveness affecting the share of local content in domestic demand will also affect the import dynamics. Following the accelerated GDP growth, the output gap has narrowed recently, but it is still significantly negative, as implied by all methods of its estimate we use, which is a Kalman filter, production function approach, and Holdridge-Prescott filter. All these three methods imply that the negative output gap will be further narrowing throughout the forecast horizon and will get close to zero in the second half of forecasting horizon. Potential GDP growth, estimated by the same three methods, will accelerate from the current pace of approximately 1 or 1.55%. The positive effects of accelerated domestic economic growth on domestic labor market can be seen in this graph. Employment growth expressed in full-time job equivalent figures turned positive in the first quarter of this year after several quarters in negative territory. Further acceleration of this variable can be expected in the rest of this year and will be primarily driven by increases in hours worked per employee, whereas the number of employees will continue in gradual increasing. As you know, until recently, the nominal wage growth figures have been affected by tax optimization effects that meant that some extra money or some bonuses were shifted from 2013 back to 2012 in some categories of high income brackets people. This effect has now faded away completely, and we can expect smooth nominal wage growth development in which the acceleration expected by our forecast is plainly seen. This acceleration will be driven by pronounced economic growth of domestic economy, and the nominal wage growth in business sector will reach approximately 5% in 2015-2016. After several years of increasing, the rate of unemployment reached its peak at the turn of 2013-2014 and started to decline. Our forecasts expect that this rate of unemployment or share of unemployed persons will decline further over the forecast horizon, given the increasing demand for labor. As I already mentioned, the forecast assumes that the use of exchange rate as a monetary policy instrument will continue until the third quarter of 2015, and market interest rates are supposed to be flat at their current very low levels until the same period, until the third quarter of next year, which will be followed by an increase in market rates by about 0.5 percentage point in the rest of the 2015, and further we can expect their growth in 2016. Let me now briefly compare the new forecast with the previous one. Outlook for headline inflation as well as for monetary policy relevant inflation has been shifted downwards compared to the previous forecast, and the reason was the lowering of both administered prices and net inflation outlooks. In contrast, GDP outlook has been revised upwards in 2014, in which faster recovery of investment and higher consumption were reflected. On the other hand, in 2015, GDP will grow at a slower pace compared to what we expected in previous forecast, due to somewhat less but still expansionary fiscal policy. The actual outlook for nominal wage growth is significantly higher, reflecting the more pronounced growth of wages at the beginning of this year, and reflecting also better prospect for economic activity in the current forecast. The trajectory of nominal interest rates was lowered which reflects more anti-inflationary external environment, lower domestic administered prices, and a corresponding shift of the assumed exit to more distant future, exit from the current monetary policy regime. So in this graph, you can see that the downward revision of the headline inflation is approximately around 0.6, 0.8% on average on the forecast horizon. The shift downwards is roughly the same for the monetary policy relevant inflation, as the assumptions on indirect exchanges haven't been changed significantly. Net inflation was revised down, which reflected a strong downward shift in PPI outlook, PPI in the euro area, and lower than expected food price growth we observed in last couple of months. As for the administered prices, there are only negligible differences in their outlook for this year, whereas in 2015 we did a downward revision which reflected the planned abolition of most healthcare co-payments. Higher forecast of core inflation was given by faster economic growth expected in the new forecast, and by higher wage growth especially in business sector. And in this upward shift in the outlook of core inflation, also the slightly weaker exchange rate was reflected. The food price outlook is currently lower compared to what we thought about it in previous forecast, reflecting the fact that we were a little bit surprised when we observed the data for the second quarter of this year, and we also did some downward revision concerning the outlook of agriculture prices. GDP forecast. Czech GDP forecast has been revised upwards for this year, which reflected mainly higher expected investment activity and better prospect for household consumption. As you can see, on the other hand, for 2015, there was mild downward revision in GDP figures, which reflected less expansionary fiscal policy expected now compared to what we thought about it in previous forecast. The fiscal impulse, the positive fiscal impulse, declined from 0.8 to 0.5 in the new forecast for 2015. We can expect in the new forecast that the consumption will grow more strongly, in which better outlook for labor market will be mirrored, and we can also expect that investment recovery will be faster, and this upward revision is given by reconsideration of expected private investment. On the other hand, the new forecast foresees slightly smaller contributions of net export to GDP dynamics, which will be given by the fact that, on the other hand, we can expect higher growth of export, which will, on the other hand, be more than compensated by higher domestic demand for imported goods. The wage growth in the new forecast has been revised slightly upwards for this year due to observed data for the previous quarters and months, which were surprising us on the upside, and following the fact that in the new forecast we expect overly better economic conditions and higher economic growth, especially for the near term. In the short term, following that, the share of unemployed persons will decline a bit more quickly compared to what we thought about it in previous forecasts, just due to the better economic outlook. As you can see in this graph, the interest rate path consistent with the new forecast was shifted downwards for 2015 due to later assumed discontinuation of the use of the exchange rate as a monetary policy instrument. This shift, meaning that there is a need for longer-lasting easing of monetary conditions, is given by the already mentioned lower outlook of both foreign PPI and foreign nominal interest rates, as well as by domestic regulated prices, which outlook will be also shifted downwards. Ladies and gentlemen, let me for now thank you for attention, and I am passing the floor back to the chair.
Thank you for your presentation, Mr. Carl, and now let me flow to the second part of this meeting, which is a discussion with our representatives. So today joined us our Vice Governor, Mr. Vladimir Tomšik, and our Chief Economist, Tomáš Holub, and Petr Král as well. So let me open up the discussion now. Thank you.
I will take the floor if I can. Yeah. Well, first of all, ladies and gentlemen, let me welcome you to the bank. Good morning, and I'm very pleased to take like first batch of the questions. So I would be happy to take like 2-3 questions, and because it makes me more happy to answer what I really want. And I think all of you know that we have already changed the model of the meeting with you. So I will be ready to answer just the questions regarding the general view of the whole bank board. So I will not present my personal view, but really the view what was discussed yesterday, on the bank board meeting. And regarding the personal views, we will be happy to have, discussions with you once the minutes, will be published. It will be next Friday. Yep. So let me start discussions. Do we have some questions? Helena Horská first, please.
Helena Horská from Raiffeisen Bank. If I can have 2 questions, I will.
Go ahead.
So the first one is to Vladimir Tomšík. It's still valid that the exit from FX regime is gonna to go ahead of the first rate hike? This is the first question. And the second question, more funny way to Mr. Král. The exit from current monetary policy regime means still the exit from the current FX regime or the exit from inflation targeting regime? Thank you.
Right, so we do have 2 questions. Do we have some more questions before we start answering? Mr. Sobíšek.
Pavel Sobíšek, Unicredit Bank. I have also a question, 1 or 2, related to the FX intervention mode. I've noticed that there are 2 sets of wording describing this mode, and I'd like to understand why. One is related to the present and speaks about tool to weaken monetary conditions, and the other speaks about tool of monetary conditions and is used in relation to 2015 and onwards. So my question, is this difference meaningful? And also, shall we regard the extended FX commitment till 2016 rather as a complement to the macro scenario which was presented by the staff, or is it a deviation from the staff forecast?
Thank you. So we do have like 3 questions in total. Let me start with, answering the first one regarding the timing of exit and timing of increasing interest rates. I think we have already, communicated that according to economic theory, it doesn't make a sense to start, increasing interest rates and at the same time declare that we do have a floor for exchange rates. Usually because, well, there are some international players regarding the interest rate differential. So it's still valid that first when we see that, the inflation is in the, I would say, very close to inflation target, Well, we can start exiting using the second tool of the monetary policy, I mean using the exchange rate. And after that, we can come back to use the standard one, the first one, interest rates. It's still valid. The second question was for Mr. Kral. Is it correct?
I probably mispronounced myself. By exit from the current regime, I meant exit from the use of the exchange rate as a tool for monetary policy easing, from the exit from the exchange rate commitment.
And I will take the questions regarding the extended FX regime. I mean, using FX as a second tool. There was a question whether it's a significant deviation or not. Well, let me come back to the forecast. Forecast is prepared by staff. Of course, there are some inputs coming from the bank board for the staff, what we really see regarding macroeconomic environment, etc. And I also have to say that the forecast was prepared, the timing of the forecast, I mean, the staff started working on the forecast, it was more than 5 weeks ago, something like that. And, you know, they're really working on that at that time. But there was a discussion, I mean, among the bank board members yesterday. Some members, a majority of the members said, well, we see some slightly anti-inflationary risk regarding the forecast. And yesterday it was presented by governor, at least there were 2 risks. First one, I mean, the most significant was the current, I would say, current inflation environment in Eurozone. Inflation, it means very low inflation, maybe even some deflation risk in Eurozone. And the second one was the current situation in food prices. But honestly, it was clearly said yesterday, it's very for a short period, because in medium run, we still expect the average harvest time for next year. So mostly the anti-inflationary risk is based on the current inflation development in Eurozone. Once the bank board said, well, we see some anti-inflationary risk, well, so we accept the forecast, but we decided to do something. And you have 2 options. First one is, well, to decrease interest rates, but we are already, I mean, in zero lower bound, so this was something what we didn't vote for that yesterday. And the second tool what we have, it's exchange rate. But regarding the exchange rate, and we had a discussion yesterday on that, this is something that we don't think it's really the right tool for fine-tuning, yeah? And that's why when we see some anti-inflationary risk regarding the forecast, we decided to extend using the second tool. That's why we said, okay, the forecast is based on the exit in the 3rd quarter 2015, but we decided to clearly declare that now we think the exit will be in 2016. And regarding the wording, I will pass the floor to Tomáš.
You probably refer to the wording in the statement of the bank board, which in the first paragraph says that the exchange rate is used as a tool for easing monetary conditions, and in the last paragraph it says it's used as a tool of monetary policy. This is not supposed to signal anything, it's just a matter of wording. In particular, in the first paragraph, we keep the wording unchanged from the very beginning of the regime, in which really there was a big easing of monetary conditions when we shifted the exchange rate to a weaker level. And because this first paragraph is basically the press release that we publish immediately after the meeting without any chance to further elaborate on it until the press conference, we simply keep the same wording, not to send any confusing signals, but it's the fact that we use now exchange rate as a tool of monetary policy because we needed to ease further the monetary conditions at the zero lower bound. This is not suggesting anything. Please don't look for any hidden meaning behind it.
Thanks for clarification. We try to be transparent as much as we can, of course. Yeah. So let me take the second batch of the questions. Arashida.
I have questions regarding your, let's say, Eurocheck development and your forecast. The first question is, what would have been, say, your estimate of current 3-month PRIBOR level if Eurocheck was, let's say, 27 since November 2013? And the second one is that you raised your Eurocheck forecast to 27.40 for the next few quarters. What is next few quarters? Is this monetary policy horizon, or it's the exit of from these FX interventions?
So let me clarify a little bit more. So your question was regarding the PRIBOR. What would be the PRIBOR if the current exchange rate were 27? Exactly?
No, not current, but if Eurocheck was 27 from November 2013.
I hope it's more technical question, isn't it? Let me take some more questions. Okay, it was the first one. Please.
Petr Rufek, CSOV. I would like to know how strong is your view on the wage development, because as I see the inflation forecast and the forecast for the consumption and GDP is based on strong wage growth in 2015 and 2016. So therefore, what's the reason for more than 5% increase of wages in those years? Thank you.
Thank you for a question. Well, I'm very pleased to say that, by the way, we had a discussion yesterday regarding the wage growth among the bank board members. So I will be happy to deliver, what kind of discussion, what kind of answers we had regarding the questions. So one more question, please. We don't have, so Tomáš, may I ask you to answer Jaromír Šinda's question? 2 questions, by the way.
Yeah, well, I'm not sure whether I fully understand the question concerning PRIBOR, because at the moment we take the assumption that until the exit from the exchange rate instrument, PRIBOR will remain at a level which is consistent with technically zero repo rate, which is just 5 basis points per annum, plus the prevailing money market spread between the 3 months PRIBOR and 2-week repo. So even with a different exchange rate, our forecast would now still be based on the same assumption as regards PRIBOR. Of course, the overall monetary conditions would be less relaxed if the exchange rate was at 27 at the floor rather than at around 27.40. But this wouldn't be reflected in the forecast of PRIBOR, but in the forecast of inflation, which would be lower than the current forecast. Maybe an implication for the PRIBOR prediction would be that maybe the assumed exit would be even more shifted into the future. So the PRIBOR would be stable at the current level for a longer period because it would take longer time to achieve the inflation target if the exchange rate was at 27 rather than 27.4. And, well, as regards your second question, well, when we moved into the current regime, we decided to suspend temporarily the publication of the thin chart with the exchange rate predictions. So we don't want to be extremely specific on our forecast of the exchange rate. In the next few quarters, it doesn't mean 1 or 2. It's basically what we can see is that the exchange rate has stabilized above the floor, and even after our discussions with our trading department, we don't see any reason for a very fast return to the floor. But we certainly still expect that as the exit will be approaching, the exchange rate will get closer to the floor. But I don't want to be too specific on what date we exactly assume now that we'll be back at 27.
Thank you. Maybe just two things to add to this answer. First of all, regarding the exchange rate, well, that's why we clearly said that using of the second tool will last a little bit longer, or quite long enough that we see there will be definitely increase in nominal price level. Why I'm saying that? Because we still believe that monetary policy can affect real variables, but we can affect nominal variables. And if it, lasts long enough, there is no economic, background that once we exit the regime, that the nominal exchange rate should appreciate back to the levels that it was before we started. Yeah. And we still keep this idea. And if someone wants to start some speculation, look, first of all, well, the party has to find counterparty. And it's not easy. So that's why we really work with this assumption. Regarding the PRIBOR, and Tomáš clearly said, well, that's why we published that until there is an exit regarding the forecast, the third quarter 2015, PRIBOR is stable. And we also work with the stable, I would say, spread between 2-week repo rate and market PRIBOR. There, we don't expect any changes in this. We can call it as a risk premium spread, whatever. So we still expect it's stable. And now let me answer the second questions regarding the wage development. And I'm looking at the figure number 21, which is clearly described that for 2015 and beginning of the 2016, we really expect nominal wage growth in business sector will reach or even will exceed 5% year on year. And Bank Board had discussion on that yesterday. And we ask ourselves what's behind. If you take some basic macroeconomic facts, which is 2% inflation target, so a real wage growth should be around 3%. And what do we expect regarding GDP growth for this year? It's 2.9. For next year, it's 3%. And for 2016, it's 2.8. So for next 3 years, there will be around 3% in real GDP growth year on year. And we expect growth in productivity, because what's behind this GDP growth? Well, it's real investment. So it makes sense if you look, at the future. If your forecast is based on to reach steady state, well, finally it makes sense to expect a real wage growth at 3% plus inflation target 5%. Of course, the discussion what we had yesterday is it's based on steady state. And we know that Czech economy in past, there used to be nominal wage growth around 6-7%. So compare 6-7% to 5% is not a big deal, 5%. But the question is whether Czech economy is not currently living in very low nominal environment. That's the big issue. And that's why we still say we are, dedicated to do everything to accomplish our inflation target, to avoid the really deflation, I would say, problem. We do everything to move our economy to the inflation target to 2%. And this is once, if people in business are surprised with 5% in nominal wage growth, this is something as a signal whether we are not already in a very low inflation environment. That's why we are here to do everything to move the economy back to the 2% inflation target. That's all what I want to say according to that. So let me take some more questions if we do any. Please.
Petr Páča, CSOB. My question will follow my colleague's one, and I was just wondering if you tried to somehow estimate the effect of lagged wages growth. If the wages don't grow as fast as you think currently. Thank you.
Please, another question.
Martin Pohl, generally PPF Asset Management. I have also technical questions regarding medium-term dynamic of some variables. Administrative prices are expected to grow about +0 in 2016. This reflects the futures, or it's rather the steady state assumptions about about administrative prices. The same is about food prices. The food prices are expected to return to an interval of about 3–4%. It's a steady state assumptions, or what the factors behind. And finally, investments. In the medium term, you still expect very slow investment growth, single-digit numbers. What are the restrictive factors behind? Thank you.
There was a couple of questions, but it doesn't matter. Do we have some more questions? Yeah, Russian delegate.
Ramir Citibank. I would have also technical questions regarding export growth forecast, which is higher. So what is behind this export growth forecast? Is it the initial state of weaker exchange rate forecast?
Mm-hmm. Thank you for your questions. Probably I will answer some of them, and most of them I will just pass to, again, head of the department, Tomáš Holub. Regarding what kind of calculations, what kind of expectations, what kind of buffers we do have if we see that the wage growth really doesn't, wage growth in economy doesn't follow our forecast. Of course, it's one of the risks, but so far we haven't discussed this risk. But what I want to say, my question is, we see some early positive development in real economy. We see some positive development in labor market. And why now, the wage growth shouldn't follow the positive development in both sectors, in real economy as well as in labor market. And as I said, we had this discussion yesterday. On one hand, 5% year-on-year change in nominal wage growth, it can be something what this economy hasn't seen for several years, because there was something as a, I don't want to say crisis, but definitely there was a real recession in economy. But on the other hand, we do have an experience that, there was a nominal wage growth in Czech economy, 7–8%, something like that, in several years ago. So this is something what shouldn't be surprised. And this economy used to have potential growth around 3–4%. So if we do have, something as a potential growth like 3–4% plus inflation target, it seems to me that, or the bank barrister say, well, 5% nominal wage growth, this is not something what is absolutely unrealistic, yeah? But of course, we do have some calculations regarding the lags. Regarding the questions on food prices, very simple answer in a very short period. Of course, we look what's going on regarding the current harvest, but regarding the forecast for next year and the following years, we always calculate with average harvest. Nobody, it seems to me, even if we take consensus forecast from abroad, well, it seems to me that nobody is able to work on a perfect forecast regarding the weather conditions for next year and for next 2 years. So it's always based on average, on average harvest. Regarding the investment single digit, well, that's the questions whether this economy in the longer run, especially in a steady state, has a potential to have investment with the double digit. But I'm pretty sure that Tomáš Holub, he's the right person to answer some of these figure questions, I would say.
Okay, as regards the administered prices, the forecast for 2016, it's 1.2, which is still somewhat below the assumed steady state. And in particular, it's pulled down by an expected slight decline in natural gas prices for households, which is based on the market outlook for those prices, the futures. Besides that, we more or less expect kind of normal slow increases in other regulated prices, broadly flat or very slightly increasing electricity prices. You will have a detailed table on it in the inflation report that will be published next Friday. But the main factor slowing it down will be the natural gas prices. As regards the food prices, well, as Mr. Tomšík mentioned, the growth around 2% in from mid-2015 onwards, it's basically based on an implicit assumption of normal harvest, and it reflects the market futures for the key agricultural commodity prices that we use to do the prediction. As regards the investment growth, I should probably mention that in 2015 there is actually one factor which will be supporting fixed investment and which we assumed in the forecast, and it's the contribution of the EU funds, because we assume that there will be an effort to draw down as much as possible from the previous allocation. And of course 2015 is the last year when you can do it due to the T+2 rule. Then in 2016, the drawdown of EU funds will actually be a slight drag on investment dynamics, because the previous programming period will be over and the new one will already be ongoing, but still there is a tendency in the first years for a weaker drawdown, which is then concentrated in the last few years of the programming period. So this also partly affects the expected profile of fixed investment in our forecast.
The last question had Jaromír Šindel regarding Tomáši, the export figures, yeah, and exchange rate.
Yeah, it's both. The export forecast is higher, mainly due to the observed faster growth in the first quarter. That's true. The somewhat weaker assumption about the nominal exchange rate is contributing slightly as well, but here I should remind you that the weaker exchange rate in nominal terms does not necessarily imply a weaker real exchange rate, because at the same time what we are discussing here is that foreign price growth in the euro area is more subdued. So that pushes the real exchange rate towards appreciation via the inflation differential. Now, not on the overall CPI basis, but if you look at the PPI in the manufacturing sector, which is probably relevant for price competitiveness. So I would say that the real exchange rate is a small contribution to it, and the main contribution is the observed higher export growth, and at the beginning of this year, maybe to some extent also the faster investment, which is having positive implications for the estimated productivity growth, etc.
Thank you. So it's exactly midday. So let me ask you to have the last batch of questions, if we do have any questions. Mr. Sobíšek, once more.
If I'm not mistaken, Vice Governor Hampel was missing in 4 of the 5 meetings, policy meetings held so far this year. So this was not part of the central bank's culture in the past, so frequent absence. And my question is, whether other board members find this a problem or find this or believe this influences the quality of policy discussions. Thank you.
All right, some more questions? Or we'll finish with this one regarding the corporate governance. All right, so that's the last questions. Well, really the easiest way how to answer this question would be the business as usual, honestly. Look, time to time it happens that you do have some business meetings abroad, and really we do have 7 members of the board. Each member is responsible for something. And this is something as a coincidence that Mr. Hampel, he's responsible to supervise monetary policy department, as well as international regulation department, and finally the market operation department. And what I remember that, for example, it happened in June, yeah, that he had to attend the international seminar provided by the International Monetary Fund. And it was really something as a coincidence that he's responsible for monetary policy, and he had to deliver presentations regarding how we carry our monetary policy in the Czech Republic to the IMF. So he was the right person to go there for this business, trip. And we don't say exactly whether it's a business trip or you do have a holiday. And by the way, it's summertime. Look around. There are just few of you. Usually there are more than 20 analysts, and we do have summer holiday. So I'm very positive that it's a business as usual. There is nothing behind. And what is really important, that there must be a majority to have a BAN board meeting. I think I can just provide some hints. As I said, there are 7 members responsible for something, and I'm pretty sure that this is not something unusual. It will happen again in the future, and not regarding only Mr. Hampel. It can happen to me, for example, because I'm responsible for supervision. If there is a Basel committee, I will have to go to attend Basel committee. You have to, and in some international meetings, there is no way to be replaced, definitely. Thank you very much for coming here, for your attention, and for your discussions. And I think I can announce that the next meeting with you, with analysts, will be in November. And this is something, it's a rule that once it's the last one for the year, it will be attended, not by Mr. Tomšík or by Mr. Hampel, but by Mr. Governor. It will be attended. Yeah. Thank you for coming, and have a nice day and weekend.
Thank you.